Hello and welcome to our 24th lesson. And today we want to discuss why and how accounts are used. So remember, in our previous lesson we were discussing about the liquidity, the profitability ratios. We want to determine, we want to see how our business is performing. So you look at a number of ratios. So today we want to see why and how accounts are used. Now, limited companies must publish their accounts for the public to see. Alright? It is used for ratio analysis. So if you have a limited liability company, a public company, the law requires that they publish their accounts to the public to see. Why? Because they have to be accountable to the members of the public. Now, this is done for ratio analysis. Now, all types of stakeholders will be interested in seeing these accounts to see how well business is doing. Now, in our initial lesson, we discussed about stakeholders. We talked about business stakeholders. And we looked at the stakeholder objectives. So, what do we say a stakeholder is? You remember? I hope you do. Now, just to remind us, saying a stakeholder is any person who has a direct interest in how the business operates. Right? Someone with a direct interest in how the business operates. If we look at a school, who are those people who are interested in how a burera performs? We have students. Very much interested because it is their life at stake. How they perform in their final exam determines a lot of other things thereafter. A second group of stakeholders are the parents. These are the people who are paying school fees. They want to see their kids excel in their studies. They want to see their kids have a religious dream. We have the teachers. These are another group of stakeholders. We have the community around, right? They want to see role models. They look at those students, they want to see this. We have the financial institutions like the banks, right? The school goes to the bank for a loan. The bank is interested in see how this school has been performing business-wise, so that to see if they lend the school money, does the school have the ability to repay the loan? We have the government. The government designs a curriculum. Right? The government wants to ensure that these students are going to be taught according to the national aims or the national goals or values. Right? These are all stakeholders. So we are saying every stakeholder is interested in seeing their accounts. We talk about the account. What are we looking at? We are referring to the balance sheets. We are looking at the cash flow forecast. What are the projections in the next 10 years? What does the business expect to make? Right? We are looking at the income statement. We want to see what is the amount of profit or loss the business has, how many assets does the business have, and so on. Alright? Now, the managers. This is one of the stakeholders. Why does the manager want to look at the accounts? They want to keep an eye on the performance of the business. Right? Compare these ratios with the competitors and the previous years to make decisions. So when you hear that the Chief Executive Officer of Kenya Commercial Bank, or KCB, is paid 21 million shillings in bonuses every year. Right? What does that tell you? It's because as a manager, as the CEO, he has ensured the bank is profitable. It has been able to compete with the rest. So he has to be compensated. He has to be rewarded for the work he has put in. So he will be keen to see how the business, he has to come up with innovations. He has to try and make the business competitive within the banking sector. Another set of stakeholders are what we call the shareholders. Right? These are people who own shares in the company, and we also have the potential investors. Those who want to see that the business is doing well, then they can also invest. So they want to see how profitable the business is using the ratios to see if it is worth investing in it. Now we talked about the profitability and the liquidity ratio. There we looked at the gross margin profit ratio. We looked at the net profit margin ratio. We looked at the rate of return on capital invested. Right? Then we looked at the liquidity ratios, we looked at the current ratio. So as a shareholder, when you look at these ratios, you're able to see whether your money was wisely invested or not. If the business is having liquidity problems, then you know very well your money has not been wisely invested. And as a potential investor, you will not want to invest in such a business. That's why you want to see the accounts. What about the banks? Why do they want to look at their accounts? Why are they interested in knowing how the business is performing? Now, banks want to see if the business is performing well to calculate the risk on whether to give out a loan or not. Right? When you go to a bank look for a loan, they have to look at your risk of default. If they give you a loan, do you have the capacity to repay, or you will be unable to repay? That's why they want to look at accounts. And the last group of stakeholders are the employees. These are the workers or the staff. Why are they interested in the accounts? They want to see how the business is, and therefore their job is safe. If they see that the business is having liquidity problems, it cannot settle smaller debts, then they know their jobs are not very safe. That's why they want to see the profitability or the liquidity ratios. To get up there. Now, we want to look at external influences on business activity. Right? External influences on business activity. Now, from what you read, we are looking at people from outside the business and how they influence the performance of that business. For example, start by looking at government economic policies and objectives. Now, there are two types of business environments. Rather, there are two types of people or two factors that influence how a business operates. We have what we call internal business environment, and we have what we call external business environment. Now, the internal business environment basically refers to the owners of the business, the finances they have, the business structures, the business culture, and so forth. But now, we are looking at the external aspect, the people from outside who have an impact on our business behaviors. So we are starting by looking at the economy, the government. So the government regulates all business activities, and it has its own economic policy. The government has objectives it wants to attain. One of them is inflation, right? Now, when there is an increase in average prices of goods and services, this is what inflation is all about. When there is a persistent, right, gradual increase in commodity prices over a given period of time, and these goods should be those that are consumed by an average citizen, right? Most of the people. So, what is the economic policy of the government on inflation? The government wants three main economic objectives. One, low inflation. Low prices of goods and services so that people will buy more, meaning more money in the economy. That is one objective of the government, low inflation. The government wants that prices remain low so that people can be able to buy more. That means more money will be pumped into the economy. Number two, another economic objective of the government is low employment. Now, high percentage of people working so that they don't rely on government funds. So any government wants to have a very low rate of unemployment so that people don't have to rely on the government for handouts and stimulus. Thirdly, the government wants economic growth. Now, the growth of the GDP, or the gross domestic product of a country, means more goods and services are being produced and sold. Right? So the government wants to ensure that the GDP of the country is very high. There's a lot of goods and services being produced so that people will pay taxes, as they produce. And that brings us to the end of our first part of the lesson.